3 years ago, this couple had a net worth of just $8,000. Not 8,000 in savings, 8,000 total. That's after subtracting debt, after counting everything they owned, after facing the reality of credit cards, car loans, and a small emergency fund that barely covered 1 month of expenses. Today, their net worth is over $220,000. No lottery win, no viral business, no crypto gamble, no inheritance. Just structure. When people hear numbers like this, they assume something dramatic happened. A huge promotion, a lucky investment, a sudden windfall. But the truth is more practical and more powerful. They built a system, and the system changed how money moved through their lives. Because here's the uncomfortable reality. Most people don't have an income problem. They have a money flow problem. Money comes in and disappears. Raises feel invisible, bonuses vanish, months pass, and net worth barely moves. If you're in your 20s, 30s, or even 40s, and you feel like you should be further ahead by now, this video is for you. If you're in a relationship and you've ever had quiet stress about money, unspoken resentment about spending, or confusion about who is responsible for what, this is for you. If you make decent money but still feel financially fragile, this is definitely for you. Because the difference between $8,000 and $220,000 wasn't income, it was design. In this breakdown, I'm going to walk you through exactly what they changed. Not theory, not motivation, the actual structure. How they organized accounts, how they divided roles, how they invested during volatile markets, and how they avoided lifestyle inflation in 2023 to 2026, one of the most unpredictable financial periods in recent memory. And I want you to pay attention to one thing while you watch. Where is your money leaking? Because when you identify the leaks and redirect the flow, growth becomes almost mechanical. Before we go deeper, comment below with your current net worth range. Not for comparison, for clarity. Is it under 10K? Between 10K and 50K? Over 100K? Writing it down forces awareness. If you value practical, calm, realistic financial strategies, subscribe to Fin Explains Money. No hype, just systems that work. Now let's break down how $8,000 became $220,000 in 3 years. 3 years ago, this couple looked financially normal. Combined income about $95,000 a year, renting, 2 car payments, some credit card debt, small retirement contributions through work. On paper, they weren't struggling. They paid their bills on time, they weren't reckless, they didn't feel irresponsible. But their net worth told a different story. After subtracting liabilities, they were worth $8,000. That number shocked them, not because it was catastrophic, but because it revealed stagnation. They had been working for years, earning, saving a little, investing sometimes, and yet the result was almost flat. This is where most people make the first mistake. They assume they need to earn more. But they didn't start by chasing income. They started by mapping their financial architecture. Step 1 was clarity. They listed every asset and every liability: bank accounts, retirement accounts, car values, remaining loan balances, credit cards, even small subscriptions, everything. Then they calculated their true burn rate, the exact number required to maintain their lifestyle. What they discovered wasn't dramatic overspending, it was drift. Subscriptions that auto-renewed, eating out creeping upward, insurance premiums quietly increasing, small upgrades that felt harmless but compounded. Individually, none of it was reckless. Collectively, it was expensive. This is where most couples argue. One person blames the other, one defends spending habits, emotions rise. They made a different decision. They treated the situation like a business audit. No blame, just numbers. That shift alone removed emotional friction. Next, they redesigned their account structure. Before, they had 1 joint checking account, 2 individual credit cards, random savings transfers when extra money existed. In reality, extra money never truly existed. So they built a layered system. Income flowed into a primary operating account. From there, money automatically split into 4 categories: essentials, investments, emergency reserve, and lifestyle spending. Automation was critical. They stopped relying on discipline and started relying on structure. Here's the key insight. Discipline fails under stress. Systems don't. By setting fixed percentages instead of vague goals, they eliminated negotiation every month. This was the first major shift that accelerated growth. The second shift was role clarity. Before, both of them kind of managed money, which meant no one fully owned it. They redefined responsibilities. One handled tracking and account optimization. The other handled investment research and retirement allocation decisions. Both reviewed together once a month. That meeting lasted 30 minutes. It created alignment, and alignment compounds faster than income. Now let's talk about the math. In year 1, they didn't dramatically increase income. Combined raises added maybe $6,000 total, but they increased their savings rate from roughly 12% to 32%. That difference alone changed everything. On $95,000 income, 12% savings equals $11,400 per year. At 32%, it's $30,400. That's nearly a $19,000 difference without changing careers. They weren't extreme. They didn't eliminate all fun. They redesigned spending around values. Dining out went from random to planned. Vacations were budgeted in advance. Big purchases required a 30-day rule. That one rule prevented thousands in impulse upgrades. At the same time, they addressed debt strategically. Instead of spreading payments evenly, they targeted high-interest balances first, while maintaining minimums elsewhere. Interest is reverse compounding. Eliminating it early accelerates everything that follows. Within 14 months, all high-interest consumer debt was gone. Now their cash flow had space. Instead of absorbing raises into lifestyle, they automatically increased investment contributions by 70% of every raise. This is how they avoided the most common trap between 2023 and 2026, lifestyle inflation during inflationary pressure. As wages rose modestly, so did costs. Many households felt stuck despite earning more. They locked growth in before they could spend it. Now we move to investing. They didn't chase trends. They built a 3-layer approach. Retirement accounts first, maximizing employer match. Tax-advantaged growth vehicles next. Low-cost, broad index exposure for long-term compounding. No day trading, no meme stocks, just consistent allocation during volatile markets. Between 2023 and 2025, markets experienced swings driven by interest rate shifts, geopolitical tension, and inflation recalibration. Instead of reacting emotionally, they continued automated investing. This is where psychology matters. When markets dropped, they increased contributions slightly, not dramatically, just enough to take advantage of lower valuations. Because wealth isn't built in stable years, it's built in uncomfortable ones. By the end of year 2, their net worth had crossed $140,000, not because of a massive return, but because contributions were strong and consistent. In year 3, income finally increased meaningfully. One partner received a promotion, the other negotiated a salary adjustment. Combined income rose to about $120,000. But here's the difference compared to most households. They didn't redesign their lifestyle. They redesigned their investment rate. Savings and investing climbed toward 40% of net income. That final year created acceleration. Compound growth plus high contribution rate pushed them past $220,000. Now pause. This wasn't magic. It was 3 core principles: clarity, structure, and automation. Most people try to fix money with motivation. They fixed it with architecture, and architecture scales. Let's break down exactly how you can apply this model, regardless of whether your starting net worth is $8,000, negative, or already six figures. First, calculate your true net worth, not an estimate, exact numbers. Second, define your burn rate. What does your life actually cost? Third, decide your target savings rate, not what sounds good, but what moves the needle. If your savings rate is below 15%, growth will feel slow. Between 20 and 30%, momentum builds. Above 35%, compounding becomes visible within a few years. Next, automate immediately after income hits your account. Not at the end of the month, at the beginning. Pay your future first, then assign roles clearly if you're in a partnership. Ambiguity destroys progress. Finally, increase contribution rates with every income bump before lifestyle expands. That single habit may be the most powerful one in this entire case study, because raises feel small monthly, but invested consistently, they are transformative. Their journey proves something simple. Net worth is not a reflection of income alone. It's a reflection of intentional design. And once the design is correct, time does the heavy lifting.
Now let's go deeper into the mechanics that made this growth sustainable instead of temporary. Because hitting $220,000 once is not the real goal. The real goal is building a system that continues working even when motivation drops, markets fluctuate, or life gets complicated. What separated this couple from most households wasn't just a higher savings rate, it was how they structured decisions to reduce friction. Most financial plans fail not because the math is wrong, but because the behavior is inconsistent. They engineered around that. After the first year, when high-interest debt was gone and their savings rate crossed 30%, they faced a subtle danger: comfort. Progress creates confidence. Confidence can quietly turn into relaxation. Relaxation turns into spending drift. They prevented that by introducing what they called annual compression. Every January, they reviewed three numbers: their total net worth, their total contributions from the previous year, and their total lifestyle spending. Then they asked a simple question: if income stayed the same this year, could we increase our investment rate by 3 to 5% without lowering quality of life? Not dramatically, just slightly. That small compression kept momentum alive. In 2024, they increased contributions by 4%. In 2025, another 3%. By 2026, they were investing close to 40% of net income. Not because they were extreme, because they optimized slowly. Now let's talk about their emergency strategy, which played a critical role during market volatility. Instead of holding a vague 3 to 6 months of expenses, they defined emergency reserves in 2 layers. Layer 1 was pure liquidity, 6 months of essential expenses in high-yield savings. This covered rent, utilities, groceries, insurance, and minimum debt payments. Layer 2 was strategic liquidity, a separate buffer for opportunity. This second layer changed everything. When markets dipped in late 2023 and again during interest rate adjustments in 2024, they didn't panic. They had capital ready. Most investors freeze during downturns because they fear job instability. This couple separated emergency survival from opportunity capital. That psychological separation allowed them to deploy funds confidently when valuations were attractive. They didn't try to time bottoms. They simply increased contributions during red periods. This is important. Volatility is emotionally loud, but mathematically temporary. By reframing downturns as discounted accumulation periods, they stayed consistent. Now let's address something many couples avoid discussing: income inequality within the relationship. In their case, one partner eventually earned more. This often creates tension. They handled it by maintaining a percentage-based system rather than a fixed dollar system. All joint expenses were covered proportionally to income. All investments were proportionally funded. This avoided resentment and maintained fairness. Money arguments rarely come from numbers. They come from perceived imbalance. By using percentages instead of fixed contributions, they protected relational stability. And relational stability protects financial progress. Next, let's examine how they increased income without increasing stress. Instead of chasing side hustles randomly, they focused on primary income optimization. Each partner identified the single highest leverage move within their career path. For one, it was a certification that increased promotion eligibility. For the other, it was renegotiating compensation after documenting measurable results. They didn't work more hours, they increased value. That distinction matters in 2025 and 2026 when burnout is common and job markets are competitive. Higher income is most powerful when it's sustainable. Within 18 months, combined income rose by roughly 25%. But here's the discipline. They did not inflate housing. They did not upgrade cars. They did not increase fixed obligations. Fixed expenses are dangerous because they reduce flexibility. Instead, they kept fixed costs stable and let variable investment contributions absorb growth. That choice accelerated compounding dramatically. Now let's look at their asset allocation. Their portfolio wasn't complex. Broad market index exposure formed the core. Domestic and international diversification reduced single country risk. A modest bond allocation provided stability during rate shifts. They rebalanced once per year. That's it. No daily checking, no emotional trading, just annual alignment. Many investors sabotage growth with over-monitoring. Checking investments daily increases emotional volatility. They intentionally reduced visibility. Accounts were reviewed monthly for contributions, annually for allocation. This lowered stress and increased consistency. By the end of year 2, their net worth graph began to curve upward instead of moving linearly. This is where compounding becomes visible. The first $50,000 felt slow. The move from $100,000 to $200,000 felt faster, because compounding is quiet early and obvious later. Now let's examine a mistake they almost made. In year 2, after seeing strong progress, they considered purchasing a larger home. Emotionally, it felt justified. Financially, it would have increased fixed expenses by over $1,200 per month. That single decision would have reduced their annual investment capacity by nearly $14,000. Over 10 years at moderate returns, that could mean 6 figures in lost compounding. They paused. They ran the numbers. They delayed the purchase. This wasn't deprivation, it was sequencing. Large lifestyle upgrades are not forbidden, they are scheduled. Sequence protects acceleration. By year 3, when income increased meaningfully, they revisited housing decisions with stronger cash reserves and a higher down payment. Now the upgrade became strategic instead of impulsive. This is a core lesson. Wealth grows fastest when fixed costs remain controlled. Let's talk about their money meetings. Every month they reviewed net worth change, contribution consistency, upcoming irregular expenses, and career progression goals. These meetings lasted 30 minutes. Phones off, no distractions. The purpose wasn't to judge spending, it was to maintain alignment. Consistency in communication prevents emotional buildup. Financial stress often accumulates silently until it explodes. Their structure prevented that. Now let's address behavioral fatigue. High savings rates can feel restrictive over time. To prevent burnout, they built a reward structure. Each time their net worth crossed a major milestone, $50K, $100K, $150K, they allowed a controlled celebration budget. Not extravagant, intentional. This reinforced progress psychologically. Human behavior responds to milestones. Ignoring celebration can reduce motivation, but uncontrolled celebration can erase gains. They balanced both. Another important factor in their growth was insurance optimization. As income and assets grew, they increased liability coverage and reviewed health insurance plans annually. This seems minor, but risk management protects compounding. One uninsured event can destroy years of progress. Financial growth is not just accumulation, it's protection. Now, let's connect this to the 2025-2026 environment. Inflation has moderated compared to its peak, but cost pressures remain. Housing affordability continues to challenge younger households. Interest rates, while stabilizing, are higher than the ultra-low period of the early 2020s. In this environment, cash flow efficiency matters more than ever. The old model of minimal savings and reliance on market growth alone is fragile. High contribution rates create resilience. This couple didn't rely on extraordinary returns. They relied on strong input. Input control is always more reliable than return prediction. That's a powerful shift in thinking. Instead of asking, what will the market do, they asked, what can we consistently control? Savings rate, skill growth, spending discipline, risk management. Those variables compound predictably. Now let's talk about the emotional shift that happened around $200,000 net worth. Security. Not luxury, security. They described sleeping better. They described reduced anxiety about job changes. They described feeling optionality. Optionality is the ability to choose.
Choice reduces stress, and stress reduction improves decision-making. This is the deeper benefit of net worth growth. It's not the number, it's the freedom buffer. But here's something important. They did not stop at $220,000. They reframed their goal. Instead of chasing a net worth target, they defined a financial independence ratio. Annual investment income potential divided by annual essential expenses. When that ratio approaches 1, work becomes optional. This reframing shifts focus from accumulation to sustainability, and sustainability creates long-term confidence. Now, how do you apply this if you're starting with debt or negative net worth? The order remains similar. First, eliminate high-interest liabilities. Second, build survival liquidity. Third, automate investments. Fourth, increase contribution rate gradually. Fifth, optimize income strategically. Do not reverse the order. Many people try to invest aggressively while carrying high-interest debt. That's financial friction. Eliminate friction first, then accelerate. Another lesson from this couple is simplicity. They avoided complexity. No exotic assets, no constant strategy shifts. Simplicity reduces errors. Errors are expensive. Finally, let's discuss time. 3 years feels short, but 3 years of focused structure equals decades of random effort. Most households drift for 10 years and see little progress. 3 years of intentional design can reset trajectory permanently. If they continue at their current savings rate with moderate returns, crossing $500,000 becomes mathematically likely within several years. Crossing $1 million becomes realistic within a decade. Not guaranteed, but highly probable. That's the power of system-based growth. It removes hope as a strategy. It replaces hope with structure. If you look at their journey objectively, nothing was dramatic. No extreme deprivation, no miracle investment, just clarity, alignment, discipline, and automation. And that is replicable. Not easy, but replicable. When money stops being emotional and starts being architectural, growth accelerates. That's how $8,000 became $220,000, and that's how momentum becomes lasting wealth.